Tarot. Today, we're digging into something absolutely fundamental to investing: portfolio allocation. And here's the thing, it's not just about trying to pick winners. It's about how you build a structure that's designed to stand up to pretty much anything.
All right, so let's start with a puzzle. It's one that trips up a lot of people. Picture this. You've got two really sharp investors. Both of them are holding great assets. We're talking solid companies, good bonds, the whole deal. But one of them sees this nice, steady growth, while the other is just on this wild, stressful roller coaster. So what gives? Why are the results so incredibly different?
Well, the answer isn't just about what they picked. It's about something deeper, something that's really easy to miss. It's not about the quality of the bricks. It's about the blueprint. The real difference in both their returns and how they feel about it comes down to the structure they built.
And that right there is the big idea we're exploring today, this concept of your portfolio as a blueprint. It's a total shift in focus, right? We're moving away from just picking the best materials and starting to think like an architect.
So what exactly is portfolio allocation then? Simply put, it's the strategy behind how you combine all your different assets. It really is the master plan, that blueprint that decides how every single piece fits together to make one solid structure.
And this really breaks it down perfectly. On one side, you've got asset selection. This is what most people obsess over, right? It's like picking out the flashiest marble, the strongest steel. But then on the other side, you have portfolio allocation. That's the design. That's deciding how much steel goes where, how the glass fits in, all to create a building that doesn't just look good, but can actually stand up when things get rough.
So when you think like an architect, you quickly see there are two main ways to build, two big design philosophies. And they're each designed for a very different kind of environment. We're talking about concentrated versus diversified structures.
First up, you've got the aggressive design. Let's call it the skyscraper. This is where you go all in on just a few big ideas, a concentrated portfolio. And yeah, the upside can be huge. You can reach for the sky, literally. But what happens to a skyscraper in a storm? It feels every single gust of wind, right? It's way more vulnerable to that market volatility.
Now, the other approach is the defensive design, the fortress. This is all about diversification, spreading your investments out far and wide. Its main strength? It's stable, it's resilient, it's built to survive just about anything. Now, a fortress isn't going to scrape the clouds, but you can be sure its foundation isn't going anywhere.
Okay, so how do these two different designs, the skyscraper and the fortress, actually hold up when a real financial storm hits? To get that, we have to look at these invisible forces, these things that put stress on the entire structure.
And the key concept here is something called correlation. It's just a fancy word for how two different assets move in relation to each other. If we stick with our building metaphor, it's basically the physics of the structure. How do the steel beams and the glass panes react together when an earthquake hits?
And listen, this isn't just some academic theory. Check out this quote from JP Morgan. During a crisis, they see correlation go to 1. What that means in plain English is that all these different assets that are supposed to hedge each other, they suddenly start doing the exact same thing. They move together in lockstep, and usually that direction is straight down. It's like the steel, the concrete, and the glass in your building all start to crack at the exact same time.
So why does that happen? Well, this next bit gets to the heart of it. It's not really a failure of financial physics, it's a failure of human psychology. As this research shows, during a real crisis, herding behavior just takes over. Everyone stops thinking for themselves and just follows the crowd. And that collective panic is what forces everything to move together. It's what makes diversification seem to fail, right when you thought you needed it the most.
And this leads us to maybe the most important idea of all. The blueprint of your portfolio, it's not just about managing financial risk out there in the market. It's about what it does to you, to your own mind. It's really an architecture of behavior.
Think about it like this. The design you choose directly shapes your emotional journey as an investor. If you build a shaky, volatile structure, you're going to have a shaky, volatile state of mind. But if you build a resilient one, you're more likely to feel resilient too. And this taps into a deep, deep human bias, something called loss aversion, which Kahneman and Tversky famously wrote about. All it means is that the pain of losing $100 is way, way stronger than the pleasure of gaining $100. It's a mismatch, and that imbalance, that's the fuel for panic when markets start to fall.
You can actually see this playing out in the data. Look at that first number, the herd measure. Before a crisis, it's higher, but during a crisis, it drops like a rock. That's the data showing everybody's stampeding for the same exit. And the second one, the disposition effect, is just as fascinating. Normally, we hate selling our losers, but in a crisis, that flips completely. We panic and dump everything, usually at the absolute worst moment, just feeding the fire.
So there's the link, right there. A shaky portfolio, our skyscraper in a hurricane. It leads to these gut-wrenching losses that set off all our psychological tripwires. That loss aversion kicks in and we panic. But a resilient portfolio, the fortress, it smooths out the ride. It acts like a shock absorber, not just for your finances, but for your emotions. It helps protect you from yourself.
So where does that leave us? What's the big takeaway? The master architect, the really smart investor, knows they can't predict the weather. They don't even try. Instead, they put all their effort into designing a structure that's so well built, it can handle whatever the weather throws at it.
Which leads to one last thought. Maybe we've been asking the wrong question all along. Instead of asking, what's the market going to do, which is basically just fortune-telling, a much better, much more powerful question is, how is my structure going to behave when the market does what markets do? See the shift? It moves you from prediction to preparation.
Decoding these kinds of unseen patterns is what we're all about here at NeuroTarot. So, if you enjoyed this, be sure to subscribe as we continue to explore the hidden structures that shape our world.